Now let's pick up on taxation for you. And I'm going to pop over to the whiteboard for this one because this is a bit of an update, bit of a refresher, if you like, for those of you who are into limited company taxation. Because it's been changing in the budget, isn't it? It changed, then it went back again, now it's gone back again. It keeps changing. So I just want to highlight for you exactly what it's all about. So let's head over to the whiteboard and give you a couple of minutes on this topic, shall we? So hi everybody, over here on the trusty whiteboard. Now the topic I want to talk about right now is limited company taxation. Now you might think, oh no, not that again. But the fact is, it's a very important topic, particularly for mortgage advisors who deal with certain types of people. Now I live in Cheltenham, and Shelley and I joke that Cheltenham is like the town of consultants. You can just tell it's full of consultants. It's probably why we've got more restaurants than any other town in the UK. But a consultant is somebody, she works for herself and she sells her brain and she operates as a consultant. But anybody can, of course, be self-employed. And what we're talking about here, and we'll put a title up for you, we'll put business taxation is what we're talking about here, business tax. Now, as far as you are concerned as a mortgage advisor, you need to be aware of this because you will get people coming to you who've set up businesses around them. And effectively, we're talking here about an individual, aren't we? Somebody, let's put our lady in here. Here we go. Da-da-da. She's set herself up as a consultant or whatever she wants to do. There you go. And she could, if she wanted to, just operate as a sole trader. She would just be taxed as an individual. And that's another topic for another day. But she's decided to set up as a limited company. And she goes along to the company's house, pays some money, it's only 12 quid, and she sets up a company around her. And effectively, therefore, she has surrounded herself with a limited company. Let's put this company there for you. She's surrounded herself with a limited company. So that's a limited company, not difficult to set up. There you go. Company's house here in the UK, and she's now got a limited company. Now, she is now a director and an owner of that company. So that's worth just putting up there quickly for you. She is now an owner of the company, so she owns the firm. So effectively, she owns the shares, but they're not traded or anything ridiculous like that. She just owns 50 shares or something. But she's also the director and the managing director, because there's only the one director here. It's just herself operating. She's now a director of the firm, which means she's an employee of her own firm. And she can call the firm what she wants. She can call it, Abacus Consulting, or anything she wants to, really. Apologies to any company that's actually called Abacus Consulting. It's quite a good name, isn't it? And that's the point. Now, why does she do this? Well, she does it for taxation advantages predominantly, but there are other benefits as well. She's now got legal liability, limited legal liability. She's bigger in the eyes of clients, so she might get bigger clients, bigger businesses. She's got, I guess, more credibility because she operates as a limited company. Now, she's got to be a bit careful with IR35, as we call it. Now, IR35 is a club. IR35 is a club. I was watching a documentary on Saturday about the Hacienda in Manchester in the 80s and 90s. Acid, that sort of kind of stuff. And of course, we're talking about a club because what you don't want to do is you don't want to join the IR35 club. Now, this was changed in the mini-budget in September, then it was brought back in again, then it was changed again. You're either in, out, shake it all about. But the fact is, it's back in again now. And what you don't want to do is you don't want to join this club. If you join the club of IR35, that means that you are going to be designated as an employee by HMRC. Because she probably works for a few firms, but she might only actually work for one company as a consultant. And she's got to be careful with that because if she gets into the club, then she will have to make herself an employee, or the company she works for predominantly will make her an employee. And that, of course, changes everything when it comes to taxation. So she basically doesn't want to join the IR35 club. And she does that by working for a number of firms, making herself truly sole trader, self-employed, or director of her own company, because they can be umbrella companies. The HMRC aren't stupid. They know people set these things up, but they're only on their own. So push that one aside. Let's look at taxes. Now, the one that's changed is corporation tax. It keeps changing. Now, this company that she's set up with her as the owner, the director, is going to make profits. You would hope so anyway. That's the whole point, isn't it? So this company's going to make profits. And if it makes profits, then she's going to be happy. If she makes a loss, she's not going to be happy. But the whole point is it makes a profit. Now, it's not a complicated business because she probably sells her time for a fee. She's got a number of costs she can deduct from that. There are some deductible expenses in running a business. She might base herself at home, so she's got electricity costs, gas costs, maybe a room, a portion of her rent or her mortgage can come over as a cost. Petrol driving to clients' offices, maybe a car of some description. She might be able to offset costs around that. She can have a computer, she can pay software, she can have licenses. All these things are genuine costs that she can offset against her fee income. But other than that, it's not a complicated business, really. So if you're dealing with a mortgage for this lady and she gives you her accounts, then all you look for really is the profit, because that's broadly what she's going to be taking home, ideally, from the business. But profits are profits. So she'll declare profits. Now she has to pay corporation tax on the profits. That's the point. Profits, you have to pay corporation tax. Now that's the one that's been changing in the last few budgets. You know, it was at 19%, then it was at 25%, then it was back down to 19% again. It's back down to 25% now. Now, what's happening with a business when they make profits? You have to pay corporation tax once a year. So even if she takes nothing out of that business in dividends or salary, which we'll come on to in a second, she just leaves everything in the business bank account. She will have to pay corporation tax once a year. Now, it comes down to the level of her profits. You don't really know too much about this, but the small company rate of 19% is only for profits of less than 50 grand. And that's 19%, just to keep you up to date. Now, you've probably read about the 25% one, but that's only for companies making more than £250,000 in profits. So more than 250 equals 25%. So generally speaking, it's big companies, really. I mean, an individual on her own, it's pretty difficult for her to make 250 profits on her own, just working 7 hours a day. So for most of these, like owner-director businesses, they're not going to make that sort of profits. But there is a taper. So between 50 and 250 profits, it goes from 19 to 25%. So for example, if she makes £100,000, e.g., she makes 100 grand, say, which is quite possible as profits, that is, by the way, then she has to pay at 22.75. But don't worry about those figures. You can look those things up. So there is a taper that she has to pay. So that's corporation tax, which she has to pay. Now, she will probably want to take some money out of the business, otherwise she ain't going to pay the bills. So she's got two ways of doing that. The first way in which she can deduct money from the business is through dividends. Now, she's an owner of the business. There you are. She's an owner, so she will have shares in the business. Because she owns a share, it's not traded, she's entitled to pay the shareholder a distribution of profits. So she can pay herself some profits through share dividends. It's as simple as that. She can pay as much as she wants. Broadly, it's whatever profits are made in the business, because you can't really pay a dividend unless there's profits. There's ways around that. But effectively, she pays herself dividends. And the dividends, I'll put them over here for you, divs, are treated just like any other dividends from unit trusts or shares, that sort of thing. And it's taxed accordingly. Now, the first £2,000 is tax-free. So that's quite a nice little bonus, isn't it? But then the rest of the dividends are taxed in her own personal taxation. And you can get this by SA 302, they call them, don't they? Which you can get from the HMRC. People will have the amount of dividends they're paying themselves and the amount of tax they have to pay. There's 3 levels of taxation. It's back up to the higher figure, 8.75% for a basic rate taxpayer, 33.75% for a high rate taxpayer, and 39.35% for an additional rate taxpayer. Different rates, they're in the tax sheet, don't need to worry about that. But you have to pay a percentage on those dividends. They're slightly less than income tax. Yeah, they are. Not a lot less, Bear in mind she's got to pay corporation tax as well. So, they're getting pretty much on par now with an employed person who pays income tax. But the other thing she can do, what many do, is they pay themselves a salary as well. Now, as a director, there you go, she's entitled to pay herself a salary because she is an employee of the business. Now, she can pay herself what she wants as a salary, and then she's taxed as a normal income. There's no big deal there. Now, most tend to pay a salary around about the personal allowance limit. Now, the personal allowance for this year is 12,570. Let's get that right. And it'll change depending on when you're watching this video, but check the personal allowance. What they tend to do, people, is they pay themselves a salary of around about that sort of figure. Maybe slightly more, maybe slightly less. What they're looking to do is to minimise the income tax on that charge. Because you pay yourself 12,570 exactly, that's tax-free, you see. So income tax, which is payable on that, could be very, very low. And that's the whole point behind it, very low indeed. So that's why you see often, they pay themselves a small salary to offset against income tax. And sometimes they might have somebody helping them out in the business from which they'll pay them a salary too. They might have a spouse, for example. She might bring her husband or partner in, and he will be paid a salary as well. He might help out with the books or something like that. So obviously the more salary she can take, the less profit she makes, therefore the less corporation tax. But that's what you tend to see as well. Now, they'll often, national insurance, of course, rears its head here, but what they try to do is pay just over the threshold for national insurance. They pay a couple of quid in national insurance to give them the annual stamp, if you like, so they get a full stamp for national insurance. That tends to be how it works. Obviously, the amount of salary that they pay, less the personal allowance, of course, is then taxed at normal income tax, 20, 40 and 45%. Now, as far as you're concerned as a mortgage advisor, you will want to make sure that you can arrange a mortgage for this lady, and you'll need to put your case to the lender. Now, most lenders are happy enough to take dividends and salary. So they will treat her as self-employed. They kind of treat her in that way. But they'll add up her dividends, they'll add up her salary, and that's usually what they will take into account when it comes to lending to her. They might have a look at the accounts to work things out. It's up to them, really. They probably won't. They will often ask for what's called an SA 302, which is an Inland Revenue, or HMRC, I should say, form which people get by doing their accounts. They can submit their accounts in January through the self-assessment. And as a result of submitting her account, she will be able to print off an SA 302 and give that to you as the mortgage broker. You can use that with the lenders to show all of the income, salary and dividends that she brings into her personal account, effectively. She will need an accountant, of course. The accountant will do the books at the end of the year for her, and the books, of course, determine the corporation tax bill, company's house returns, that sort of thing. As far as the mortgage is concerned, it's salary and dividends that you're looking for, really. Some will look at the accounts, but don't really. That's broadly the taxation of a small business person who owns her own account, her own business, effectively. So we're all changing, isn't it? But that's the updates for you. But let's be useful.